Peachtree Financial Analysis, Case B, by Daniel Andresen. For Peachtree, we assume that it has a constant growth rate. By this we mean that the constant growth rate is equal to the initial dividend times 1 plus the growth rate all over P initial plus the growth rate. With this, we can calculate such things as annual dividend, which is par value times the percent cumulative dividend. This is 0.0432 times 100, which gives us $4.32. To calculate the quarterly dividend, we take the annual dividend divided by 4, which is $4.32 divided by 4, which equals $1.08. For the quarterly return, it's the quarterly dividend divided by price per share. $1.08 divided by 48, which is the price per share, will give you 2.25%. To calculate the nominal annual return, is the quarterly return times 4. So 4 times 2.25% will give you 9%. For the effective annual rate is 1 plus the quarterly return times 4 minus 1, which give you an effective annual rate of 9.31%. In order to value the stock correctly, we need to calculate the expected rate of return for Peachtree. This will give us an accurate number on what to base our investment purposes off of. To calculate the expected rate of return, you take K is equal to the first dividend divided by P initial plus the growth rate. So for this instance, K is equal to 1.8, which is the dividend, divided by 22.26 plus 6%, giving us an expected rate of return of 14.09% for Peachtree. To calculate expected dividend yield and expected capital gain, we have to look at the growth rate again. Expected dividend yield is equal to the dividends paid in the first period divided by P initial, which would give you 8.09%. Capital gains yield is equal to the growth rate, which is given at 6%. Since both dividend yield and capital gains grow at a rate of G, which is constant, then they will remain constant over the same periods of time. In order to use the constant growth, or Gordon model, it is required that the per-share dividends are expected to grow at a specific constant rate indefinitely. This is the case with Peachtree because G, the growth rate, 6%, is going to be the same indefinitely. Companies' earnings are expected to grow at the same constant rate and payout remains constant. Real-world stocks of larger companies can satisfy these requirements necessary for using the Gordon model, constant growth rate. In order to calculate the stock price for Peachtree in the future, we need to calculate dividend yields per year. For this, we need to discount the dividends at a rate of 6%, the growth rate. For the initial year, the dividend is $1.80. For year 1, you multiply $1.80 by 1 plus the growth rate, 1.06, giving you a dividend of 1.908. For year 2, you multiply the dividend 1.8 times 1 plus the growth rate, 0.06, to the power of 2, giving you a dividend of 2.022. This is done to the power of 3, then to the power of 4, then to the power of 5, and ultimately the 6th year, where it's 1.80 times 1 plus 0.06 to the 5th power times 1 plus 0.075, giving you a dividend for the 6th year of 2.59. As stated in the previous slide, discounted cash flows are important to calculate the expected stock price for a specific year in the future. The dividends and constant growth rate are used to do this. For example, if you look below, to find the expected stock price at the end of 1992, assuming that the stock is in equilibrium, you need to find the expected price or value at the end of each year, merely move year by year along the timeline, and calculate it. For example, dividend 1, 1.908, is divided by 1 plus 13.5% to the first power, plus second year's dividend, 2.022, divided by 1.135, which is 1 plus 13.5% to the second power. Then you do to the third power with the third dividend, the fourth power with the fourth dividend, and so on, until you reach the desired year and you calculate the future value of that stock. To calculate the expected dividend yield, capital gains yield, and total returns, you need to take each year, T, and then use the dividend yield as DT divided by PT minus 1. And for the capital gains yield, parentheses PT minus 1, parentheses, divided by PT minus 1. So for the dividend yields, this would amount to $1.80 divided by 28.56 equal to 6.3%. Similarly, for the capital gains yield, it would be 30.62 minus 28.56 all over 28.56, yielding 7.2%. To figure out total returns, you add dividend yields and capital gains yields, amounting to 13.5%. Overall, one thing we can tell is that a 6% dividend growth in the first 5 years, which increased to 7.5% after that period, the stock's expected rate of return is 19.13%. Because this is higher than its required rate of return, it's a good and attractive investment for investors. In conclusion, valuation process of any asset is a function of, firstly, amount and timing of future cash flows, and secondly, the riskiness of future cash flows. Cash flows are associated with bonds are more certain than cash flows associated with stocks. Overall, stock values are required rate of returns move in opposite directions. A stock's required rate of return can be calculated using either the CAPM method, bond yield plus a premium, and or non-constant growth model. The greater the growth rate of a stock's dividends, the greater the stock's value. Overall, the total yield of a stock is a function of the dividend yield and capital gain or loss. This is the case for Peachtree stock. Thank you, Papa Shiroki. You're too big to fail.